Welcome back. Today, we're going to answer a simple question. How do IHSG or Jakarta Composite Index, the Indonesian Rupiah, and Indonesian government bond yields move together in normal times versus crisis? We'll look at tail correlation using 15 years of daily data and see what this means for your equity, FX, and SBN or government bond positions. First, let's talk about the setup. I'm using daily data from 2010 to 2025 for three markets: IHSG, Jakarta Composite Index; USDIDR, the Rupiah versus the US dollar; IDR 10-year government bond yield. From this, I compute. First, IHSG returns, log returns of the index. Second, USDIDR returns, log returns of the FX rate. Third, yield changes, daily change in the 10-year SBN yield. Then I split the sample into three regimes using IHSG crisis. Bottom 10% of IHSG daily returns. Boom, top 10% of IHSG returns. Normal, the middle 80%. So when I say crisis, it literally means days where IHSG is getting hit very hard. Let's start with normal days. On this slide, you see three scatter plots: IHSG returns versus USDIDR returns, IHSG versus 10-year yield changes, USDIDR versus 10-year yield changes. Notice how the cloud of points is quite flat between IHSG and USDIDR, and also between IHSG and IDR 10Y. In normal times, the correlation is modest, around -0.2 between IHSG and USDIDR, and roughly -0.18 between IHSG and the 10-year yield. That means, on an average day, equity moves and Rupiah moves are connected, but not extremely. You can still get a weak equity day with a stable Rupiah, or the other way around. Now compare that to crisis days, the bottom 10% of IHSG returns. Look at the scatter on the left, IHSG versus USDIDR. The cloud is now tilted much more strongly. When IHSG drops, USDIDR tends to move up. Rupiah weakens much more consistently. The middle chart, IHSG versus 10-year yields, also shows a clearer pattern. Deep equity sell-offs are often accompanied by rising yields. Foreign outflows hit both stocks and bonds. And on the right, we see USDIDR versus the 10-year yield. During crisis, a weaker Rupiah tends to come with higher yields. Visually, you can already feel the flight to safety. All the bad things move together. Let's make this more precise with correlation heat maps. On the normal regime heat map, IHSG versus USDIDR correlation is about -0.20. IHSG versus IDR 10Y is about -0.18. USDIDR versus IDR 10Y is roughly +0.40. So in calm markets, the relationships exist, but they are not ultra strong. Now look at the crisis heat map. IHSG versus USDIDR becomes around -0.32. IHSG versus IDR 10Y deteriorates to -0.40. USDIDR versus IDR 10Y stays positive around +0.36. The message is clear. When the market crashes, the correlation between IHSG, Rupiah, and SBN gets stronger and more one-directional. Risk-off in equities comes together with Rupiah weakness and higher yields. Correlation is not static, so I also plot a 60-day rolling correlation for the three pairs. The blue line is IHSG versus USDIDR. The orange line is IHSG versus the 10-year yield. The green line is USDIDR versus the 10-year yield. You can see several interesting episodes. Around the 2013 taper tantrum, the blue and orange series dive strongly negative. During COVID in 2020, correlations spike again. Equities fall, Rupiah weakens, yields move sharply. Outside those stress periods, correlations flowed closer to zero, especially for IHSG versus USDIDR. This tells us A static correlation number in a risk report is misleading. What really matters is where we are in the cycle. So what can we actually do with this? Here are a few practical ideas. Regime-aware hedging. If the rolling correlation between IHSG and USDIDR drops below, say, -0.4, we treat it as a risk-off regime. In that environment, an equity book that's long IHSG should be partly hedged with long USDIDR or long SBN duration shorts, because they will tend to move in your favor when equities fall. Cross-asset confirmation. When you see IHSG down, but USDIDR and IDR10Y calm, that looks more like stock-specific or technical selling. But when all three move together, index down, Rupiah weaker, yields higher, that's a macro shock. Risk management should react faster. Stress test scenarios. Using the crisis correlation matrix, you can build scenarios like, if IHSG is down 5% in a day, what is the typical move in USDIDR and 10-year yield? That's more realistic than assuming constant correlations. All right, that's a quick tour of tail correlations in the Indonesian market, IHSG, USDIDR, and bonds. If you like this style of research, real Indonesian data, simple quant tools, and trading intuition, don't forget to like the video, subscribe, and share it with your friends who trade Indonesia. Thanks for watching, and I'll see you in the next quant experiment.